If you're a real estate agent, dealing with all the different kinds of financing that your buyers and sellers are coming to you with is probably intimidating. And honestly, I get it. There's so many different kinds of loan options out there. You've got conventional, FHA, VA, USDA, and all of these new non-QM programs. It seems like there's a new program coming out every other day. So on this episode, I'm going to make it very simple for you as the real estate agent to understand these loan products and how to help use them to get your clients' offers accepted. Coming up next. Alright, what's up guys? Welcome back to my channel. My name's Caton, and on this channel, I help people just like you learn how to buy their first home. I also make the mortgage process a little bit simpler, and I talk about things like marketing and real estate. So if any of that is something that you're into, make sure you hit that like button and hit subscribe so you can stay up to date with all my latest content. Alright, now that that's out of the way, I want to talk to you guys about all of these different loan products. Like I said at the beginning of this video, there's so many different kinds of loan products out there, it's really hard to wrap your head around which one makes the most sense for your clients. Now, ultimately, at the end of the day, it's going to be up to a licensed mortgage professional to be the one to be the matchmaker in this scenario and figure out what the best loan is for your client. But as a real estate agent, it's important to understand these loans and the kind of limitations that they might have so that you can make an educated decision for your buyers as well when you're looking at properties and putting together offers. Now, when you're looking at all these different loan products, a quick Google search would show you just how many there are. Now, when I'm talking to my clients, I really like to say that these loan products really fall into one of two buckets: your government loans and your conventional loans. Government usually covers things like your VA, FHA, and USDA loans, while conventional covers pretty much everything else. Now, of course, there's other products like non-QM and jumbo, but for the sake of time, we just won't get into those because those are way too confusing, and each bank has their own different variation of them. So starting off with government loans, probably the most popular, in my opinion, honestly, the best loan out there, if you can qualify for it, is the VA loan. Now, the VA loan is probably the most popular because if you are qualified to use it, you can get into a home with 0% down and get access to some of the best rates out there. Now, in the past, it used to be that it was 0% down because there were loan county limits that were in place. But now in 2020, those loan limits are completely gone. So as a veteran, buying your first home, you can get into anything from $100,000 to $1.5 million, truly this time around with 0% down. And honestly, I think that's a huge win for the men and women of our armed services. Moving right along to FHA loans. FHA loans are extremely popular loans for first-time homebuyers because it allows them to get in there with as little as 3.5% down. It also is a little bit more flexible than the conventional product, which we'll talk about a little bit later, as far as things like credit history, which is really important because not a lot of people these days have perfect credit. So if you've got something like a 620 credit score and you're kind of worried on whether or not you're going to qualify for a mortgage, this is a fantastic option for you to get into a home with as little money down as possible if you're not already qualified for a VA loan. And the last kind of government loan is a USDA loan. Now, in San Diego, where I live, these aren't super common because you have to be in a designated USDA rural area for you to actually use this loan product. So in some cases where you've got a bigger city, you might not find pockets where you can actually use this loan product. But for places where you can, it's another great first-time homebuyer option, 0% down outside of the VA product. Now, as a real estate agent, the one thing that you really want to look out for if your clients are using a government loan is whether or not they're buying a condo. And the reason why is the government is pretty strict on which kind of condominium complexes that your clients can buy if they're using one of these kinds of products. Both the VA and the FHA actually have published lists of approved condominium projects, and you can find them online, and I'll leave links below in the bio. Now, FHA recently rolled out a new feature that you can also use. If the condo, kind of makes sense, maybe it's expired, they can do what are called spot approvals, which are approvals on that individual unit instead of trying to get the entire HOA and the entire project approved by the FHA. Now, for whatever reason, there's this big misconception that government loans are worse than conventional loans. And I can kind of see why they would say that, considering that a lot of first-time homebuyers use government loans because they have lower credit scores. But that doesn't mean that they're any worse than conventional products. The same kinds of problems that arise in conventional products are the same in government, and vice versa. So don't just look at an offer or look at a buyer with an FHA or a VA financing and say, oh, that's not as strong of an offer as a conventional offer. You want to really compare them apples to apples and see if it actually makes sense. Now, moving on to conventional loans. These are loans backed by Fannie Mae and Freddie Mac typically. There are some places that hold their conventional loans as part of their portfolio, but they're more or less all the same kind of product. These are great loans for people who, for example, have credit scores over 700, although conventional guidelines say that you can actually go as low as 620 in some cases. Now that being said, doesn't mean that you should actually use conventional if your credit score is that low, simply because I personally think that the FHA is going to be a much better option, because you'll probably get access to a better rate and a lower mortgage insurance premium than if you were going to use conventional financing. Now, of course, if you are getting into a home with less than 20% down, you're probably going to have to pay this thing called private mortgage insurance. And honestly, it isn't as big or as scary as you might think it is. If you look at the math over time to figure out how much it would take for you to save that full 20% down versus how much you're paying the lender to take care of that mortgage insurance because you didn't put that down, 9 times out of 10 it actually makes a lot more sense to get into a home, start building equity right away. So that's something that you as a real estate agent might want to communicate to your clients and say, hey, yeah, you're gonna have to pay PMI, but this is gonna help you get into a home, and you're gonna be able to start building equity right now instead of waiting for you to get that 20% down, and God knows what rates are gonna look like by then. Now, I always like to say conventional buyers are usually the cleaner looking files, right? People who have a little bit more consistent job history, not as many credit issues as, say, an FHA buyer. Now, similar to government loans, conventional loans also have limitations as far as buying a condo is concerned. Now, you're not going to have these approved and not approved complexes like you have on the FHA and the VA side, but what you'll typically run into is having to have a condo review done by the lender up front. Now, it all depends on how much your client is actually putting down. That'll dictate how thorough of a review this is. It could be a full review, in which case they're going to need the full budget, CCNRs, all of the HOA docs and things like that, or it could just be a limited review where it's going to take a brief overview of some of those factors without getting too in depth. That's something you want to keep in mind if you have a conventional client who's buying a condo. You might want to look out for, is there something funky going on with this condominium complex that might prevent my buyer from getting into it? Now, some of the biggest issues that you're going to run into on condos, regardless of financing type, are usually going to be related to budget, litigation and lawsuits against the condominium complex, the rules that are actually written in the CCNRs of that HOA. So all those things you want to look out for in advance as a buying agent and a selling agent as well, if you've got clients who are looking to buy or sell their condo. Now, at this point of the video, we've talked about just briefly the plus sides and minuses of these different loan products. Now, like I said, ultimately it's going to be up to your lender to figure out what the best loan product is for your client. But hopefully this will help you understand how their loan is being structured in a way that you can help structure your offer as well to make sure that they're getting the best deal on their new home. Now, one thing I want to note here is that different lenders have these things called overlays. There's the regular published guidelines that Fannie, Freddie, the FHA, VA, and USDA publish, but some lenders out there will throw in overlays that help them manage risk. For example, FHA and VA technically don't have a minimum FICO score, but lenders will throw overlays on them to say, hey, we're not going to do VA loans under 600, for example. Now, traditionally as real estate agents, you're probably told that you want to have, 2 or 3 lenders in your back pocket, the old, I've got 3 business cards rule. But in reality, if you're working with a mortgage lender who could probably broker out this deal or has that full array of products without overlays, you're probably set. So that's something that you want to look out for when you are looking to partner with a mortgage lender. Make sure that your client's needs are taken care of, regardless of what financing that they might have. So if you as a real estate agent have any questions about any of this, leave it in the comments below or reach out to me on social media. But until next time, first one in, last one out. See ya.